Welcome to our exploration of risk and return in business decisions. Every business faces choices that involve balancing potential rewards against possible risks. Understanding this dynamic is crucial for anyone looking to make smart, informed decisions. In this video, we'll break down what risk and return mean, why they matter, and how they influence business strategies. Whether you're an entrepreneur, manager, or investor, grasping these concepts can help you navigate uncertainty and maximize opportunities. Let's start by defining risk and return and see how they shape the landscape of business decision-making. Risk in business refers to the possibility that outcomes may differ from what is expected. It's the uncertainty that comes with every decision, whether launching a new product, entering a new market, or investing in technology. Risks can be financial, operational, or strategic. Recognizing the types of risks involved helps businesses prepare and respond effectively. By identifying risks early, companies can develop strategies to minimize negative impacts and seize opportunities that others might overlook. Let's look at how risk is measured and why it's a central part of business planning. Return is the reward a business expects from taking a risk. It's often measured in terms of profit, growth, or market share. The higher the risk, the greater the potential return, but also the possibility of loss. Businesses must weigh the expected return against the risks involved to make sound decisions. Returns can be short-term, like immediate profits, or long-term, such as brand reputation and customer loyalty. Knowing how to estimate and evaluate returns is essential for setting goals and measuring success. Next, we'll see how risk and return interact in real-world scenarios. Risk-return trade-off is a fundamental principle in business. It means that to achieve higher returns, you must accept higher risks. Conversely, safer choices usually offer lower rewards. This trade-off guides investment decisions, product launches, and strategic planning. Businesses constantly assess how much risk they're willing to take for the potential return. Understanding this balance helps leaders make choices that align with their goals and risk tolerance. Let's examine some examples of risk-return trade-offs in various industries. Business risks come in many forms. Financial risks involve money like borrowing, investing, or pricing decisions. Operational risks relate to day-to-day activities such as supply chain disruptions or equipment failures. Strategic risks arise from big-picture choices, like entering new markets or changing business models. Each type requires different management strategies. By categorizing risks, companies can prioritize their efforts and allocate resources effectively. Understanding the variety of risks is the first step in building a resilient business. Measuring risk involves assessing the likelihood and impact of different outcomes. Businesses use tools like probability analysis, scenario planning, and risk matrices to quantify risks. This helps leaders make informed decisions and prepare for uncertainties. By assigning values to risks, companies can compare options and choose the best path forward. Effective risk measurement is key to minimizing surprises and maximizing return. Next, we'll look at how businesses evaluate potential returns. Evaluating returns means estimating the benefits a decision will bring. Businesses use financial models, market research, and performance metrics to predict outcomes. This process helps set realistic goals and measure progress. By comparing expected returns with risks, leaders can decide whether an opportunity is worth pursuing. Accurate evaluation is essential for strategic planning and resource allocation. Let's see how risk and return assessments influence real business choices. Risk management is about identifying, assessing, and controlling risks. Businesses use strategies like diversification, insurance, and contingency planning to reduce exposure. Diversification spreads risk across different products or markets. Insurance protects against unexpected losses. Contingency planning prepares for emergencies. Effective risk management enables companies to pursue opportunities with confidence. Next, we'll explore how risk and return shape investment decisions. Investment decisions are a prime example of risk and return in action. Investors weigh the potential rewards of an opportunity against the risks involved. High-risk investments like startups or emerging markets offer the chance for big returns but also greater losses. Low-risk options such as established companies or bonds provide steady but smaller gains. Understanding the risk-return profile of each investment helps investors build balanced portfolios. Let's look at how businesses use this principle in their growth strategies. Growth strategies often involve taking calculated risks for higher returns. Expanding into new markets, launching innovative products, or acquiring competitors can drive growth, but also bring uncertainty. Businesses must assess whether the potential rewards justify the risks. Successful companies use data, experience, and risk management to guide their growth decisions. By balancing ambition with caution, they maximize their chances of success. Next, we'll see how risk and return affect product development. Developing new products is risky but can yield high returns. Businesses invest time and money in research, design, and testing, hoping to meet customer needs and stand out in the market. However, there's always the chance that a product may fail or not deliver expected results. Managing product development risks involves market analysis, prototyping, and feedback loops. By understanding the risks, companies can innovate while minimizing losses. Let's explore how risk and return influence marketing decisions. Marketing decisions also involve balancing risk and return. Investing in advertising, promotions, or new channels can boost sales, but there's no guarantee of success. Businesses must evaluate the risk of spending money versus the potential return in increased revenue or brand awareness. By testing campaigns and analyzing results, companies can refine their strategies and maximize returns. Next, we'll look at how risk and return play a role in pricing decisions. Setting prices involves risk and return considerations. Pricing too high may drive customers away, while pricing too low can reduce profits. Businesses analyze market conditions, competitor prices, and customer preferences to find the right balance. Dynamic pricing strategies allow companies to adjust prices based on demand and risk factors. By understanding the relationship between price, risk, and return, businesses can optimize their revenue. Let's see how risk and return affect supply chain decisions. Supply chains are vulnerable to risks like delays, shortages, or disruptions. Managing these risks is essential for maintaining business operations and ensuring returns. Companies use strategies such as diversifying suppliers, building inventory buffers, and monitoring logistics to reduce supply chain risks. By balancing the costs of risk management with the potential returns, businesses can keep their operations running smoothly. Next, we'll discuss how risk and return influence hiring decisions. Hiring new employees involves risk and return. The right hire can boost productivity and innovation, while a poor fit may lead to costs and disruptions. Businesses assess candidate skills, experience, and cultural fit to minimize risks. Investing in training and development can increase the return on hiring decisions. By carefully managing the hiring process, companies build strong teams that drive success. Let's look at how risk and return impact technology investment. Investing in technology can transform a business, but it comes with risks. New systems may not work as expected or adoption may be slow. Businesses evaluate the potential return of technology investments by considering cost savings, efficiency gains, and competitive advantages. Risk management includes pilot testing, training, and ongoing support. By balancing risk and return, companies can harness technology to drive growth. Next, we'll explore how risk and return affect partnership. Forming partnerships can open new opportunities but also introduce risks. Partners may have different goals, cultures, or expectations. Businesses assess the potential return of partnership by evaluating shared resources, market access, and synergies. Risk management involves clear agreements, communication, and ongoing collaboration. By carefully selecting partners and managing risks, companies can achieve greater returns together. Let's see how risk and return influence expansion decisions. Expanding into new markets or regions is a major business decision involving risk and return. Companies must research local conditions, regulations, and customer preferences to minimize risks. The potential return includes increased sales, brand recognition, and market share. Risk management strategies include pilot projects, partnerships, and gradual scaling. By balancing risk and return, businesses can expand successfully. Next, we'll discuss how risk and return affect mergers and acquisitions. Mergers and acquisitions offer high returns but carry significant risks. Integrating companies can lead to culture clashes, operational challenges, or financial surprises. Businesses assess the potential return by analyzing synergies, cost savings, and market expansion. Risk management includes thorough due diligence, integration planning, and communication. By understanding the risks and rewards, companies can make informed merger and acquisition decisions. Let's look at how risk and return influence innovation. Innovation is essential for business growth but involves risks. New ideas may fail or competitors may respond quickly. Businesses evaluate the potential return of innovation by considering market demand, competitive advantage, and scalability. Risk management includes prototyping, testing, and feedback. By balancing risk and return, companies can innovate successfully and stay ahead. Next, we'll explore how risk and return affect customer relationships. Building strong customer relationships can yield high returns, but there are risks. Miscommunication, unmet expectations, or service failures can damage trust. Businesses manage these risks by focusing on customer service, feedback, and transparency. The return includes loyalty, repeat business, and positive word of mouth. By balancing risk and return, companies create lasting customer relationships. Let's see how risk and return influence reputation management. Managing reputation is crucial for business success. Risks include negative publicity, social media backlash, or product recalls. The return is a strong brand, customer trust, and market leadership. Businesses manage reputation risks by monitoring media, responding quickly, and maintaining quality. By understanding the risk-return balance, companies protect and enhance their reputation. Next, we'll discuss how risk and return affect sustainability decisions. Sustainability decisions involve balancing environmental risks with business returns. Investing in eco-friendly practices can reduce risks like regulatory fines or reputational damage. The return includes cost savings, customer loyalty, and long-term viability. Businesses manage sustainability risks by adopting green technologies, monitoring regulations, and engaging stakeholders. By aligning risk and return, companies build a sustainable future. Let's see how risk and return influence crisis management. Crisis management is about responding to unexpected risks. Businesses face crises like natural disasters, cyber attacks, or financial shocks. Effective crisis management minimizes losses and protects returns. Strategies include emergency planning, communication, and rapid response. By preparing for crises, companies can recover quickly and maintain business continuity. Next, we'll explore how risk and return affect leadership decisions. Leadership decisions involve risk and return at every level. Leaders must make choices about vision, strategy, and resource allocation. The risks include making unpopular decisions or facing resistance. The return is achieving goals, motivating teams, and driving growth. Effective leaders balance risk and return by gathering information, consulting stakeholders, and adapting to change. By understanding this dynamic, leaders guide their organizations to success. Let's see how risk and return influence ethical decisions. Ethical decisions in business involve weighing risks and returns beyond financial outcomes. Choices about honesty, fairness, and social responsibility can impact reputation and long-term success. The risks include legal issues or loss of trust, while the return is a positive brand image and loyal customers. Businesses manage ethical risks by setting clear values, training employees, and monitoring compliance. By balancing risk and return, companies build integrity and resilience. Next, we'll discuss how risk and return affect global business decisions. Operating globally introduces new risks and returns. Businesses face challenges like currency fluctuations, political instability, and cultural differences. The potential return includes access to larger markets and diversified revenue streams. Risk management involves research, local partnerships, and flexible strategies. By understanding global risks and returns, companies can expand internationally with confidence. Let's see how risk and return influence digital transformation. Digital transformation offers high returns but comes with risks. Implementing new technologies can disrupt operations or require significant investment. The return includes improved efficiency, customer experience, and competitive advantage. Businesses manage digital risks by planning, training, and monitoring progress. By balancing risk and return, companies can successfully embrace digital change. Next, we'll explore how risk and return affect financial management. Financial management is all about balancing risk and return. Decisions about budgeting, investing, and borrowing affect a company's financial health. The risks include cash flow problems or debt, while the return is profitability and growth. Businesses use financial analysis, forecasting, and controls to manage risks and optimize returns. By understanding the financial risk-return dynamic, companies make smarter decisions. Let's summarize the key lessons from our exploration. Risk and return are at the heart of every business decision. By understanding and managing risks, businesses can pursue opportunities and maximize returns. The key is to balance ambition with caution, using data, experience, and strategic planning. Whether you're making investment choices, launching products, or expanding globally, the risk-return dynamic guides your path. Remember, smart risk management and clear evaluation of returns are essential for long-term success. Thanks for joining us on this journey through risk and return in business decisions.